In the past, people traded goods directly, a system we call barter. Let's say Tom has a bunch of fresh apples and needs a new pair of shoes. So he goes to Sally, who makes shoes, and tries to trade his apples for them. But what if Sally doesn't want apples, or thinks her shoes are more valuable than the apples? How do they decide what's fair? It's easy to see the problem with the barter system. So, people realized they needed to find a better system to make trading goods easier. Now, let's introduce gold. Gold is valuable for several reasons. It's beautiful, doesn't decay or rust, and it is rare. So, people decided to use gold for trading things. This idea is quite straightforward. Tom can give Sally a piece of gold for shoes. But a question comes up. What if Tom's piece of gold is too valuable for just one pair of shoes? There must be a way to make smaller payments. The solution was coins. Here comes goldsmiths. Because of their good reputation, people trusted them to make coins. Coins are small, stamped pieces of gold or other metals. Each coin has a defined value, making it easier to decide how many coins a pair of shoes or anything else might be worth. Now, Tom can simply pay Sally the right number of coins for the shoes. But a new problem arises. Tom has to keep his coins safe. Where should he store them? Goldsmiths, the artists who crafted jewelry, had strong safes because they needed to protect their golden creations. Because of this, people, like our friend Tom, began storing their gold coins with them. For each deposit, the goldsmith would issue a receipt to indicate how much gold was stored. A new concept emerged. What if Tom could use this receipt, instead of actual gold, to buy things? Indeed, people began using these receipts to make purchases. Tom could give Sally the receipt as payment, and Sally could then visit the goldsmith to retrieve the gold if she wanted. However, many found it more convenient to simply use the receipt for their own purchases. The receipt, acting as a promise of gold, began to circulate among people, establishing a new medium of exchange. So, how did this system evolve into the banks we are familiar with today? The goldsmiths realized that people were not often withdrawing their actual gold. Seeing an opportunity, they began to loan out the gold to others in the form of these paper receipts, asking for a bit more back. This additional amount is what we call interest. This practice marked the goldsmiths' transformation into bankers. Now, they were not just safeguarding gold, but also managing a system of lending and borrowing using paper as a promise of real value. This practice slowly shaped into the foundational concept of modern banking. The goldsmiths found a situation in which they had an advantage. Because people used paper receipts more than actual gold for transactions, goldsmiths realized they could issue more receipts than the gold they had. It was as if new money was created without additional gold. Consider Tom receiving a receipt, even though he didn't deposit any gold. A helpful but potentially risky situation, don't you think? What if a situation arises where everyone decides to exchange their receipts for gold, and there isn't enough to go around? This leads to a risky situation known as a bank run. Imagine if word spread that a goldsmith cannot exchange all the receipts for gold because they don't have enough. In fear, people would hurry to be first to exchange their paper receipts for the limited gold available. If goldsmiths cannot provide the gold, it results in disorder and a shattered reputation. This danger constantly remained under the growing banking operations. The critical question is, how did we move from these risky goldsmith practices to the secure banks we see today? Goldsmiths started to see the advantages of lending money. They gradually turned into early banks. They kept issuing notes, even more than the gold they had, which was a risky business move. The risk of bank runs, that is, too many people demanding gold at once, always remained. But people found banks so convenient that they continued to use them. So how could this system become more stable and safer? Here, the concept of a central bank was introduced. A central bank could offer a kind of safety to other banks by holding a large reserve of gold provided by these banks. It provided a unified form of currency and acted as a backup. So, if a bank did not have enough gold to give to everyone demanding it, the central bank could step in to avoid disaster. The central bank was like a big, reliable friend to other banks, helping to stabilize money systems and keep things running smoothly. Now we face another question. How does this central bank control money and keep stability in all the banks in a country? We will explore more about this in our next video, where we dive into the interesting story of the Federal Reserve. We'll uncover how it manages to drive our economy and why it is such a key player in global finance. What secrets and systems does it use to keep things balanced? Stay tuned and ensure you do not miss our next episode, where we uncover more financial mysteries together.